I'd like to introduce my team of professionals that work with me. I'm Bill Hesch. I'm an attorney, CPA, and financial planner. I'm a personal financial specialist, which is a CPA that specializes in financial planning. I was very fortunate many years ago, almost 30, that I was one of the first 400 CPAs in the country that got certified as a personal financial specialist. So today, in a 50-mile radius of Cincinnati, there's only around 1% of the CPAs that are financial planners and certified with that designation. So what it means to my clients when we work with my clients is that when they come to a meeting, they have an attorney, a CPA, and a financial planner at every meeting. You have the experience that I've had. When I got out of law school, I was with Touche Ross and Deloitte & Touche in their tax department. If you're familiar with the big accounting firms, the Arthur Andersen that went under, I was a tax partner here in Touche, and after the merger with Deloitte, I left the firm. Deloitte did Procter & Gamble. I was with Touche Ross. We had 50 people in the office. Deloitte had 300. I worked with small businesses, and we had 15 people in the tax department that I was on top of, and then we had 30 people in the audit department. So I've always worked with family businesses. Back when I was with Touche Ross, I got involved with succession planning for business owners back with many clients, and actually was working with Touche Ross nationally when they put together the first seminar on doing succession planning for business owners and financial planning for business owners. So I have a lot of depth of experience, and that works well when I'm working with clients. Because when I left Deloitte & Touche, I was a CFO at a company, Scory Food Service. So I worked with them for 2 years. I had a 2-year covenant not to compete. Everybody's aware of that, if you're a business owner, that you'd like to have non-competes. So I was with Scory Food Service. So I got some really good experience with their succession plan, working within the company as a CFO, and Charlie Squarey for those 2 years. But Charlie was a client of mine for nearly 20 years. And I went through the whole gamut of his succession plan with him and his family. So it kind of gives you some background of where I come from, that it kind of makes me very unique when I'm working with clients, that I'm able to kind of be a sounding board and give clients a second opinion, that I work with their attorney, I can work with their CPA, I can work with their financial planner, I can wear the hat that they need. I have a great team of people that have been with me many years, quite frankly. The CPA practice we launched, I had my first employee back 23 years ago, was Carrie Carroll. So Carrie's in the back of the room. Carrie, she's been putting up with me for 23 years, but she's an accountant doing taxes in my office. And Kathy actually started with me back in the 80s at Touche Ross. Then she joined my practice a couple of years after I started it in 1993. And Kathy's a CPA with her master's in tax, and she was with me for several years, and then she had, she got pregnant with her 5th child after she just adopted her 4th child. So she took a hiatus and recently came back with me a couple of years ago. So Kathy and Carrie is the heart and soul of my tax practice. And then we have on the law side, I have Amy Pennekamp. Amy's been with me. She'll be a speaker talking about estate planning on the 3rd session. Amy's been with me for 12 years, a Chase Law School graduate, XU grad, finance. XU, right? Okay. So, but anyway, Amy works with me in the last 12 years, and we really have had a great opportunity in our business. One of the ironic things, I'm an entrepreneur. I'm a business owner. So that's kind of unique for most professionals out there that you work with. When I started my business back in '93 as a CPA, actually it was the 3rd time I was terminated in my career. And that was the miracle year of my life. I survived. I had to create business in a matter of actually 30 days. And so that story's on my website. And so very fortunate that things worked out the way that they did. And the ironic thing is that we were able to double our business in 3 years. We were able to double our business in 3 years. We were able to double our business in 4 years. To me, whether it's the practice of law, CPA, it's all about sales and marketing, quite frankly. The key, though, is that when you're out there creating this persona and you're out there marketing yourself, the key is that the inside reality has to match the outside perception. In other words, when you bring the people in, you got to deliver, and you got to be able to produce. So I'm just trying to tell a little bit of the story, because then when Amy and I Well, when the recession hit back in 2008, I had a tax practice that all of my home builders went bankrupt. All of my contractors went bankrupt. When you're losing money in a recession in '08 and '09, there's not a lot of tax planning to do. So we focused on the law firm, and we were very fortunate in 2009, 10, 11 to double our law firm practice in the recession. We got recognized by the Northern Kentucky Chamber and the Emerging 30 as the fastest growing companies in the chamber during the recession for 2 years, in 2011 and 2012. So again, when you look at operating a business, I'm here to give you some advice about how to do some tax planning, succession planning, estate planning. But I'm very experienced because I've walked in the shoes that you are as a business owner, having to manage a business, having to go through a recession, having to start a business up out of my apartment in Fort Mitchell, Kentucky in 1993. Okay? So I've walked in the shoes of a lot of you business owners, and I know what it is when you have that responsibility. Yourself with your employees. They become family. Okay? Friedman is another attorney in my office. Chris been with me for 4 years. And again, Amy and I have continued to grow the practice, and we brought on Kurt 4 years ago. So again, with Kurt, the whole concept is I have a team of professionals. And one of the interesting things, because you might tell I'm a little bit older than they are, but one of the interesting things I think is that I take a person along with me to every meeting. And we don't charge the client for that person in that meeting. But I tell my clients, they do all the work. So when you think about it, I might have a car accident, something might happen, and all my clients have been working with my team. So there's continuity. This is part of the thing I'm going to be talking about in succession planning. If something happens, which quite frankly, I had to walk in that terror last year. I'm kind of walking, living proof that you can put Humpty Dumpty back together again. Last year, I was kind of in scared to death survival mode. I was facing back surgery in February. I was off 10 days after the surgery. I had my left knee replaced in May. I was off 2 weeks after the surgery. In October, I had my other knee replaced. I was off 2 weeks after the surgery. Now, I worked pretty hard before and after every surgery, and last year was a record year for our business. So what I'm trying to share with you is that we all have health problems that come up, and I've been really healthy for a long time, quite frankly. But last year was a year of challenging. So the thing that I would share with you is that, as a business owner, it's important that you really focus on, your health and your wellness in addition to your balance in your life, so that you can really be and do all the things you want to be for your customers, your clients, and who you serve. So with that introduction, it's time for the workshop. If you all could go into your booklet, and there's a handout here, the top 10 tax planning mistakes that business owners make. And this is intended to be a workshop. So we have identified what I found to be the top 10 mistakes that business owners make when they're doing tax planning. So these are intended to be questions that you can work with your CPA on, and you can answer as you go through it. So this is intended to be that you can be able to take away. So the tax planning mistake number 1 is the failure to find out from your CPA what your tax rate is, how much are you paying in federal taxes, state taxes, city taxes, Social Security taxes in your business. You really need to know what your tax rate is. Everybody's trying to make more money. And what you're going to find out here, depending upon your type of entity that you are for tax purposes, you may be paying significantly a lot of taxes that you're not aware of. And so part of this process, to me, when you do tax planning, is you really, as a business owner, need to know what your tax bracket is, so that when you go forward, you understand the importance of making sure you're maximizing your deductions and minimizing your taxes. So if you go into the outline, back there's behind the outline is Exhibit A, and then these are going to be tools back behind the outline. If you go to page 205 on the bottom right-hand corner, you're going to see an example of a business owner that's married, and so you might be able to also on page 3 of the tax planning guide that's in your booklet, It has the current tax rates for yourself if you're married or single. You might want to refer to that because I want you to be looking at your tax bracket. A lot of business owners are Schedule C sole proprietorships. It's not uncommon to have that tax entity, and so we're going to start there. You'll see in this example that if you're married and you're a business owner and your profits are between $75,000 and $150,000, that's your taxable income, the federal tax bracket is 25%. I'll give you an example. I had a client in last week. She is getting audited by the IRS, and she wanted to come in and review things. And it's not unusual. Her husband's making a little bit over $100,000. Her taxable income last year was $90,000. She made $32,000 of profit last year as a business owner. So when you take $90,000 and you look at $75,000, I was able to explain to her that $15,000 of her profit last year was subject to federal income tax at 25%. The amount below that, the other $17,000, almost half of it, was subject to federal tax at 15%. So that's just the starting point, though. Okay, it doesn't stop there. Look at the handout on page 2. You'll see that because she's subject to Social Security taxes as a business owner, the Social Security taxes are 15%. So half of her profit is, you pay federal taxes at 25 and 15 is 40%. The other half of her profits were being taxed at 30%. And then you have the state taxes. I say 4%, Kentucky's 6%, but you get a tax deduction for it. So if you're in a 1/3 tax bracket, I just kind of rounded it off. If you're in Kentucky, you'll pay around 4% in state taxes. Kind of interesting. Ohio changed the law a few years ago. They have the commercial activity tax that business owners are subjected to. But if you're a business owner and you're in business for yourself, you have a small business income tax deduction that you basically do not pay hardly any tax at all on your profits. Zero tax in Ohio. I've been living in Kentucky my whole life, worked in Cincinnati my whole life. I'm seriously debating I need to move to Ohio because I'll save 6% of, or after if I tax affected 4% of my income, I'll save in state taxes. But as a resident of Kentucky, working in Ohio, I don't pay much Ohio tax at all because I get the deduction, but I'm still subject, all my income is subject to tax in Kentucky at 6%. I get a tax deduction for that, so it nets out to be 4%. There's also city taxes involved. My office is in Cincinnati. If you're here in Covington, different cities have 1% tax rates, 2% tax rates. But it's not uncommon. The city of Covington's 2.5%. You know, if you're in Boone County, you have Florence taxes and you got Boone County taxes. So if you're in Fort Thomas, the client that I met with had a home office in Fort Thomas. And between Campbell County and Fort Thomas, her taxes were 2%. So when you add it up, in this simple example, if you're married and your income is between $75,000 and $150,000 of taxable income, you're paying 46% in taxes here in Kentucky. If you're in Ohio, it's only 42%. That gives you a break, right? And if your income is not as much, you're still paying 36%. This lady was livid. She's trying to make, she started her business up 3 years ago. She said, what, anything I make? Because her husband uses up all the lower tax brackets. She's in a 46% tax bracket on everything she makes. Now, if she tries to grow her business $10,000, she's going to pay $4,600 in taxes. She was shocked. And I don't know what you know. So what kind of tax bracket are you in? Use this as an opportunity on the first page to list, what are you paying, what's your federal rate? What's your Social Security rate? If you're an S corporation, you do pay Social Security taxes on your wages. So you may or may not be paying the full boat on all of your profits, but to the extent that you are a business owner, the IRS requires you to pay a reasonable salary and pay Social Security taxes on your wages. So for a lot of business owners, quite frankly, a reasonable salary is all of their profits. The lady I'm talking about, if she was an S corporation, her income's $32,000. What should her salary be? $32,000. She's still going to pay 15% Social Security taxes as an S corporation because the company pays half and she pays half. So you don't avoid it. Okay? So that's important, I think, as a starting point, that the common tax planning mistake that business owners make, I think, in tax planning is you don't know your tax bracket. Now, for the lady I met with from Fort Thomas, she's very incentivized now to make sure we maximize the deductions. That's important. Now, why did she come to me? Because the IRS is auditing her because she did her tax return on TurboTax, and I identified where she made the mistakes on her TurboTax tax return. That's why she got audited. She got the letter and called me the next day. Found me on the internet. Marketing. Search engine optimization, it does work. So take a minute, if you can, to identify what your tax rate is. So you can go back to your CPA and say, how much am I paying in taxes? And quite frankly, she was shocked. She was just so livid after she found out how much she was paying in taxes. She says, I'm going to have more people. I'm going to grow my business. I go, well, that's great. Okay? Which led into the next point I'm going to talk about. Okay? As a business owner, the first thing I talked to her about is, and this is the tax planning mistake number 2. The tax planning mistake number 2 is your failure to maximize your 401k, your simplified employee pension plan, your simple IRA, or your IRA deduction for business owners so that you can try to maximize your retirement contribution. And we also typically want to minimize what we pay the employees. I mean, I'm just saying we're just not that generous. Most business owners are trying to save taxes, but the problem you have sometimes is that if you try to maximize your pension contribution, you might be, all the tax savings might be going to your employees because there are minimum requirements you have to have with a pension plan to contribute money for your employees. But a pension plan, I believe, is the best tax shelter out there for business owners. For my lady from Fort Thomas, the example was that, well, you won't save Social Security taxes, but if we take 15% off of 46, you're at least saving a third in income taxes today. So that we give her motivation, if you think about it, that if I do put $10,000 into a pension plan next year, so I can make more money, and to avoid taxes, I put it into my retirement account and I save taxes, I only have to pay 15%. I like that idea. Okay? So again, the thing that I would focus on that's out there that's also a misconception, I believe, is a lot of people are out there advocating that you should have a Roth IRA. The people that are advocating that are a lot of times financial advisors that are not tax advisors. And having worked on this a lot since they put the Roth IRA in 30 years ago, I found that if you're the question becomes, do you believe that you're going to be in a higher tax bracket when you retire? Now think about that. I don't have many clients that retire with an IRA account over $1 million. Let's assume that you would be very successful and you try to put away money in and year out. Do you think you're going to be able to accumulate over the next, till you're retired, $1 million in your IRA? So you're going to take that money out when you retire? Let's assume that you are successful in doing that. And when you're age 70, you're required to take out the required minimum distributions. It's 6%. So if you're married, you'd be able to take out $60,000 a year. Now, we just went through the tax brackets. You have Social Security typically in your IRA. Are you in a higher tax bracket when you retire? Keep in mind these tax rates have been indexed for inflation the past 30 years. Okay, so while that's the thing that, because I've been practicing over the years and I've experienced it, these tax brackets keep getting larger at the lower tax rates. So the whole assumption that you're going to be in a higher tax bracket when you retire for the average person defies logic with me, which says you would not need a Roth IRA. Okay? You would want a tax-deductible IRA because you're going to be saving taxes at 25%, and hopefully you're going to be in a 15% bracket. Do you really think that Congress is going to be taxing retirees at a higher rate when in your 70s. And by the way, let's say you're in the same tax bracket. Guess what? It's a break even, it's a wash. Doesn't matter. You have to be in a higher tax rate to lose on this deal. There's one other factor that people don't talk about. We do a lot of elder law planning. What's that mean? Age 65, the baby boomer. Your average life expectancy will be age 83. 1 out of 4 will live to age 90. 1 out of 10 will live to age 95. That's in my Social Security statement I just got this year. Also the statistic, 2 out of 3 people age 65 will be needing nursing home care before they die. And we all know what the cost of nursing homes are currently. And usually it's end of life, quite frankly. It could be a year or two. The average stay, though, in a nursing home is 4 years. The American Institute of CPA has a guide for elder law planning when I'm working with clients to do retirement planning. You should budget $250,000 at age 65 to plan for your medical expenses from age 65 during your retirement years. If you're married, you need $500,000. Now, how does this tie back to the IRA? We work with clients all the time that they accumulate money in an IRA, and when they go in the nursing home and they're paying $100,000, we take that money out. And guess what? You get a medical expense deduction on 90% of your nursing home care cost. Guess what? I want a pool of money in an IRA that I can do some financial planning and tax planning when you're older, that you can have more money to pay for the nursing home. That's the whole strategy. I do encourage clients, if you do a tax-deductible IRA, to put that extra money that you're saving in taxes into the IRA so you have a bigger nest egg. Okay? So you know, if you're in this example, if you did a Roth IRA, you'd be doing after-tax money at $10,000. Well, I don't want you to do that. I want you to go ahead and goose it up another $3,400. If you're over age 50, you can put $6,500 and $6,500. If you're a married couple, you can put $13,000 into IRA, tax-deductible IRA. So that's the example I'm giving you, that I want you to maximize what you can put into. I want you to take the tax savings and I want you to put it into the IRA. So the tax planning mistake number 2, where you don't maximize your pension contribution, I think that's something you want to review with your CPA. As a business owner, you're typically trying to balance things out. I'll give you an example of my situation. I have a simple IRA. Now, I could try to put more money away into maybe a 401k with my employees, but guess what? With a simple IRA, my minimum contribution for all my employees is 2%. So there's actually a cost that I have for me to put, $15,000 into a simple IRA. And I'm going to save, what, $5,000 in taxes. My payroll is nearly $400,000. What I'm trying to tell you is that I'm putting money away, but guess what? All my tax savings is going to my employees. Now, if I did a 401k, I'd have to put 3% in. Okay? So I'm giving you an example that most of the business owners I talk to, we're trying to do strategic planning, and we have to look at the overall picture. So in my situation, the simple IRA allows me to put some more money in, but I wanted to contribute, and I have my employees have been with me for a long time. It's part of their compensation package. That's how I look at it. So when I do their annual review with compensation, we have their income, bonuses at Christmas, and then we also look at the health insurance that I pay 100% of. We'll be talking about health insurance cost. Is another thing that business owners need to deal with their employees. So I think for your purpose, I don't know if you check the box, yes or no. Is that something that you need to talk to your CPA about? Tax planning mistake number 3. Here we go. And this leads into the medical expenses. Tax planning mistake number 3 is the failure to fund your HSA account, your health savings account, annually. This is almost, to me, if you have a high deductible plan for insurance, you get a tax deduction to put money away into an HSA account. You can invest the money there. It accumulates tax-free. And when you take the money out, there's no tax that you pay on the income and earnings that you have in your HSA account. It's a no-brainer. It's a nice tax shelter on top of the retirement accounts, even better than the quite frankly, the retirement account, because when you do the IRA and the pension plan, you got to pay tax on it when you take it back out. Here, you can put money into the HSA, you can invest it, you can accumulate it. You don't have to take the money out for medical expenses. When you're age 65, you can't put more money into the HSA anymore, but you can take money out of the HSA and use it for any purpose. Okay? So that's another one common mistake that business owners make, that they don't put money into their HSA account annually. Tax planning mistake number 4, the failure to keep adequate receipts for business expenses, and you risk losing tax deductions if you're audited by the IRS. My lady that came in from Fort Thomas. It's one of those things that I would tell you there's 3 really important strategies for not worrying about an IRS audit. You know what the 3 strategies are? Documentation. You know what number 2 is? Documentation. You know what number 3 is? Documentation. I've been through audits for the last 40 years. If you have documentation, signed off, no problem. You don't have a documentation, disallowed. IRS is getting tougher, I got to tell you. They've been training agents, or this lady got audited. She actually got audited for several reasons, but the thing that concerns her is that does she have the documentation to substantiate what she has deducted on her tax return? And let's talk about credit cards. I always recommend clients use a credit card for business and credit card for personal, so it helps you identify when you're making the purchase that is a business expense. So if you can do that, that's good. Sometimes there's an overlap, but I recommend that. I also recommend you use a credit card for your business like I do,